I know it's 10 o'clock and we should have started, but I guess people are still finding it difficult to log in and probably not familiar with the login procedures. So I'll just give it another minute or so to allow people time so they don't miss the start. So it's 2 minutes past 10, and I'll start. And if anybody joins us, then we can pick it up with them later. So welcome to everyone who's taken the time to log in and join us today. I'm sure you'll find it both interesting and thought-provoking. My name is Vic Ulfik, and I'm the Head of Innovation Tax Release for Fortus. And today I'm joined by Wayne Starkey, who is a director at Huntington Ross, a firm of independent financial advisors that we are partnering with. Today, Wayne and I will take you through a short presentation on small self-administered scheme pensions, or SSAS for short, and how this type of pension scheme could help you, your friends and family and your business all at the same time. If you have one already, then we can show you how to maximise the benefits of it. Most people don't consider that their pension is important until it's too late, or what they do have will take care of itself. Today, we'll give you an insight into what you could have and how it could change the future for you and your business. There will be time at the end for questions, so please write down any you'd like to ask so you don't forget. A copy of this presentation will be emailed to you by the end of the afternoon. I'll now hand over to Wayne, who will start the presentation.
Thanks, Vic. Morning, everybody. Yes, as Vic said, my name's Wayne Starkey, and I'm a chartered financial planner working for Huntington Ross. I've been in this business for 24 years. It was 1998 when I started. And in all that time, I have never met somebody who has their own company who has been absolutely desperate to invest in a pension. It just doesn't happen. The majority of business owners will tell me something like, well, my business is my pension. I don't like the idea of not having control over my pension. But I'm hoping that what we'll be able to do is demonstrate to you throughout this presentation that it's not necessarily the case that you can't control your pension, and indeed, further, you can use your pension within your business to help further your business goals. So the title of the presentation is myth busting. So the best thing to do is to bust some myths right at the start. So, big one, I have no control over my pension. Well, with the vast majority of pensions, that is the case. And it might be the case that you've been investing into pensions for quite some time and really don't pay them very much attention whatsoever because you're invested in some sort of fund over which you've got no control. Whilst that's true for the majority of pensions, we're going to demonstrate throughout this presentation that's not true of all pensions, and specifically where SSAS is concerned, that's not the case at all. Another concern that people have with regards to investing in pensions is what happens when they die, when I lose all the money. Again, that's not the case whatsoever. And in fact, on death, pensions can be a very tax efficient way of saving as they don't attract inheritance tax. So no, you don't lose all the money. In fact, the money can be left very simply to your nearest and dearest, anybody really that you would like to leave monies to. One of the issues that people consider is that these days you can only pay a small amount in. It's a maximum of £40,000. Now, back in the late 90s, early noughties, somebody could invest up to £255,000 into a pension in any given tax year. Whilst it's true that has come down over the years, and now the maximum is only £40,000 per annum, it might not be the case that that's the maximum that you can pay in as an individual. There's something called carry forward that's allowed within pension scheme legislation, which will allow an individual to carry forward unused pension allowance from up to 3 previous tax years. It's quite a complicated mechanism, so I won't go into too much detail, but effectively what it does mean is if you have been a member of a pension scheme throughout the past 4 tax years and haven't made any contributions into that pension scheme or any pension scheme, then the maximum you could potentially contribute to a pension this year would be £160,000. So we're talking, substantial amounts there that could be used for business purposes. This is quite an old one, but some people still think it's the case. I have to buy an annuity when I retire. That's not been the case for quite some time, actually, but the alternative up to 2015 was something called capped drawdown, which to all intents and purposes was very similar to an annuity in that the amount that you could draw from your pension at any given time was linked to annuity rates. So it's governed by the government actuarial department. So there's a maximum on what you could get out of your pension when you came to retire. However, since 2015, legislation has changed and we now have something called flexible access for pensions. And what that means is that effectively it's your pot of money. You can do whatever you want with it. There might be tax implications on any action you might take. And pension monies above the tax-free cash amount of 25% generally are accessible to income tax in the year in which they're taken. But the truth of the matter is you can do whatever you want with that pot when you can retire. You can buy an annuity if you so choose, and for some people that is still appropriate. But for the majority of pension schemes that we see, the clients will use flexible access drawdown, giving them control over that money in retirement. Are my old pensions stuck frozen where they are? It's often the case, and it was certainly the case for me. Most of my clients have worked in a variety of different employments over the course of the years. There's no such thing as a job for life anymore, unfortunately. And what that means is they've built up probably a reasonable amount of pensions in different providers, different companies, different life insurance companies. And what people tend to do is just effectively try and forget about them and just concentrate on the pension they've got. You don't need to do that. You can consolidate old pensions, if appropriate, into a new pension scheme. And that's certainly true of starting a SSAS. People can transfer old pension schemes into a SSAS, which is a good way really of getting that pot rolling. Finally, aren't all pensions the same? Well, no, they're not. We've got workplace pensions there, personal pensions, SIP and SSAS. The difference between SSAS and those other three pensions is that the SSAS pension isn't a personal pension, which brings me to my next slide. What is a SSAS pension? So SSAS, as Vic said, stands for Small Self-Administered Scheme. It's a defined contribution scheme, which means it's a scheme that you put money in that you use to invest to build a pot for retirement. But what it is it's not a personal pension scheme, it's an occupational pension scheme. So it's a company pension scheme and it's limited to less than 12 members. Typically speaking, it is used by one or more directors of a company. It tends not to be used for employees. You've got workplace pension schemes for that. It's set up by the business and it's individually registered as an occupational pension scheme with HMRC. And what that means is that the members are the trustees. Now, generally speaking, you would need a professional trustee within the scheme rules to ensure that you're actually complying with all the legislation, because members can't be expected to know pension legislation backwards. So professional trustees are required for that. But the other trustees will all be members of the pension scheme, which effectively means you, as directors of the company, you're the people who get to set the scheme rules, and you're the people who get to decide the types of assets that the pension scheme can invest in. So coming back to the earlier point about control, the pension scheme is in your control. You're not limited in the way you would be. Some clients have SIPs. Lots of my clients hold their commercial property through a SIP. But the scheme rules of the SIP, which is a master trust, govern what you can and cannot do within that pension scheme. It's different with the SSAS. You have that control yourselves. So what are the advantages? Well, as suggested there, it is a self-managed fund for investing in the development of your business. So again, coming back to control, you manage it, you manage the investments within that. If you need help with the types of investments, then obviously you can get that from third-party professionals, people like myself, chartered financial planners. It might be the case that you want to invest in pension funds with some of your funds. But there are other things that you can do within a SSAS that you're not able to do within other types of pension schemes. And principal among those, and the thing that we find business owners perceive to be the most important thing, and certainly the most interesting, is that you can make a loan from your pension scheme back to your own business. Now, there's limitations on that. You can only borrow up to 50% of the value of the scheme assets. So £1 million pension scheme, you could borrow £500,000 from the pension scheme back into the business. But what that does is it gives you the opportunity to contribute to a pension scheme without having the concerns of a cash flow, that making those contributions would be something that might negatively impact how you can actually run your business and develop your business. Because the contributions to a pension scheme, employer contributions to a pension scheme, attract corporation tax relief. So you're making the corporation tax relief saving, currently 19%, but for a lot of people increasing in the coming years. Then it's very tax efficient. So fourth point down on this particular slide, tax relief on pension payments, you get that tax relief. So a £40,000, if that's what we're talking about, contribution to a pension scheme for an individual, for a director, would save you £7,600 in corporation tax. So you can make those contributions, you can get that tax relief, but if you feel that the company might be leaving itself a little bit short with regards to the amount of capital that's available for investment, or even just from a cash flow situation, it is possible to make a loan back from the SSAS to the company. Now, the loan has to be made at a commercial rate, but you do get to set your own interest rate within that. So anything from 1% above Bank of England interest rates, up to, well, double digits would probably be too much, but 8-9%. Some people choose to go low because they like the idea of having cheap finance. So you are effectively providing cheap finance for your company, whereas some members prefer to go high because the interest actually would be growth within your pension pot. So it's an investment within your pension pot that is entirely within your control and that you're actually setting the effective interest rate for. So it's very useful in that regard, and you're not reliant on the performance of another fund with Scottish Widows or Standard Life. One of the other things that is an advantage of the SSAS is that if you're going through an R&D tax credit with Vic's team, for instance, then for those directors that are involved in the R&D side of things, any payments, such as salary and pension payments, can count towards the claim, which again means further tax savings. And I know Vic's going to talk a little bit more about that later in the presentation. Moving on. So what can you use the SSAS for? We've touched upon the loan back because that's the thing that most people consider to be the primary advantage of it. But you can do a lot of other stuff that you wouldn't necessarily have considered possible within a personal pension, such as, for instance, buying commercial property. I know you can do that through a SIP, but most other types of pensions won't allow you to do that. You can buy machinery and equipment. You can develop your commercial property within the SSAS as well. An example I've got is that a client bought a commercial unit within his SSAS and he decided to put electric vehicle charging points in for staff. And that was all doable through the SSAS as well, because it increases the value of the property, which again increases the value of the pensions held within the SSAS. Again, a few more of these points here revert to the loan back situation. So raising capital to fund new products, paying back CBILS loans or any other debt, not just the coronavirus debts, increasing your payments into your pension and increasing the value of your R&D claims. I think we've already covered that off. So who's it for? Well, family businesses are very good because what a SSAS is effectively a joint pot of money. So people can come together to purchase or make loan backs. An example would be I have some clients who, there's three brothers within a business. They each have a personal pension with a life insurance company with around about £300,000 in. They don't pay a great deal of attention to it. It's just in a default fund. They're paying 1% per annum for that particular pension, and they're contributing a very small amount into it. We've set up a SSAS for them. They're going to transfer those pensions into the SSAS, and they're going to maximise their payments into the SSAS as well. So we'll have £1 million within there within a very short space of time, because they're able to do that as a family. That then gives them more buying power to go out and buy £1 million property, which is something that they're eyeing up. Were they to have individual pensions, it wouldn't be as easy as doing that. So together they are stronger. They're able to consolidate all their funds into one pot and to make bigger purchasing decisions with that. On that point, people are often concerned that if they have different amounts of cash to bring to the party, so to speak. So say if my three brothers had 500,000, 200,000 and 300,000, that the SSAS wouldn't recognise that. It does. Whilst there's still £1 million in that SSAS, within the SSAS itself, everybody's individual assets are ring-fenced, and any growth within the SSAS is apportioned accordingly. So nobody misses out through having a smaller part of the pot. Doesn't have to be family businesses. It can be directors who aren't necessarily related within companies. So if those three brothers had just been three guys who'd come together to form a company, it'd work equally as well as them. For them, what they can also do is that they could include their wives in the pension scheme. They don't necessarily have to be employees, so they could be involved in the pension scheme as well, although they'd have to be employed if they were to have employer contributions made on their behalf. They could join the pension scheme and transfer in pensions of their own, again, giving the pension scheme more money to do more stuff. Speaking about who might benefit, people who already have their have business premises that they're leasing or renting. So it would be more tax efficient potentially to own that property yourselves, and as a company be paying the rent to your pension scheme rather than to another landlord. If a business requires capital, of course, you could go to NatWest or some other lender. They would lend you at 7% if you needed capital for a project. But there's cash within your pension schemes that could potentially be used for that purpose. The interest could be benefiting you rather than NatWest shareholders. But B, you could be getting it at a more beneficial rate of interest if you're concerned about the costs of that. Extracting value from business tax efficiently. Well, that's true of any pension contribution. You're getting money out of your business without any personal tax implications, and also making corporation tax savings. So pensions are really good for that particular purpose, and the SAS just gives you more control over doing that. If you're approaching retirement, it's definitely worth doing, because you could be a member of a SAS and then bring the new people within the business. If you're selling your business on or passing it down within the family, could also become members of the SAS. It might be that there's a property that your business operates out of within the SAS. You can bring new people into the SAS so that there's a continuity of business within that. Young family, again, works in the same way, and as touched upon at the top of the presentation, minimising inheritance tax liability. So if your business is in danger of tipping over into being considered to be not a trading business but an investment business, then it might be possible to move some of the funds within that into a pension environment, which those funds would be outside of the inheritance tax regime, but also could help put your business back into a position whereby it's considered to be a trading company. Case study. Okay, so I'll work through this. Apologies, because I'm pretty much going to be reading off the slide, but also adding a little bit of detail around it. So, company budget hours has 2 directors, and both spend 20% of their time in R&D work. Typical small company, turnover of £1 million and a profit of £150,000, which means that they expect to pay £28,500 in corporation tax this year, but they've got £200,000 in the bank. The business also owns the property they operate from, and it's got a value of £130,000. Directors have got personal pensions, but don't contribute very much at all. The business can make employer contributions of £75,000 for each director to a SAS, which would completely mitigate that year's corporation tax liability of £28,500. So that's £150,000 getting paid into the business. That would enable them to buy the property, because that was £130,000, which will save future potential IHT or tax upon the sale of the business. This also injects £130,000 back into the business, of course. So they've taken £150,000 out of the business to contribute to the pension, making the tax saving. But by buying the property from the business, that's £130,000 cash back into the business, which they can contribute to the SAS again, which should save them a further £24,700 in corporation tax in that tax year. We'd probably do it in a different tax year, to be fair. Now the company is paying corporation tax relievable rent to the pension scheme. So rent for the property is obviously corporation tax relievable. It's a business expense. The pension scheme is benefit from that, and so it's growing, and it's growing without any income or capital gains tax implications, because it's a pension, and that does the taxation rules around pensions. Assuming no further investments are made into the pension, the scheme now owns £130,000 property and has £150,000 in cash. If required, the company could borrow £140,000 from the scheme, because 50% of 280,000 is 140,000, by way of a loan back, choosing the interest themselves, in order to fund further R&D, if R&D was what was required, or cash flow, any other capital projects that they were looking at. So for this particular company, when you look at how the money's circled round, all they've done is save tax. And the next slide is going to then demonstrate how they could potentially save more tax, as I hand over to Vic.
So one of the issues that I come across on a number of occasions is where we are preparing a research and development tax credit claim for clients, is where the client is an owner manager and has some input to the R&D, but they're paid on a dividends basis. So if you've ever done a claim that way, you'll know that because of the dividends are a low number, we can only take a percentage of the low number. So in terms of the input from that director, the R&D costs are restricted. And this would be one way of allowing more cash to be available for the R&D costs, because if we use the employer pension payment to increase the director's payable pension into the SSAS, we can then have the percentage of that pension payment. So I'm using the example here, 40% of your time is on R&D, you can claim 40% of any employer pension for your R&D claim. So we've got an example there that says if you pay pension of 50,000, the R&D relief at 40% of that is 4,940. Now, that's a substantial amount of money. And over 10 years, and typically, lots of our clients have been doing this for at least 10 years, that's a considerable amount of money. And then also you get, as Wayne has already said, you get the reduction on the personal tax payment, plus additional savings on the sale of either HRT or on the sale of the business. And it's all used in pension legislation. Clients are able to pay for all personal life cover, again, from the company. So from an R&D tax credit point of view, and for most of the innovation tax release that we offer, this would significantly add value to an R&D tax claim. And if and because it's restricted currently, because we're due to the dividend issue, it's just one of the other reasons why the SSAS pension scheme would be advantageous to anybody who's an owner manager. Your next slide, Wayne, please.
Yeah.
So Wayne and I put together some frequently asked questions, which you can see there, and I'll probably just ask Wayne just to answer those. So how do I put a SSAS in place, Wayne?
Well, the first part of call I would think would be to contact me. Be more than happy to help with that. But essentially, it's an occupational pension scheme that has to be applied for directly to HMRC. So your company needs to be a trading company and to have been in existence for at least 12 months. If those two criteria are met, then it won't be rejected. But yeah, it's an application to HMRC. But we've done scores and scores of these things. Paperwork wise, we've got it down, so it's pretty straightforward. All you need really is some signatures.
And the next question then, typically, how long does that take?
It's a movable fee stick. So the most recent one that I had signed off took around about 8 weeks. During the coronavirus crisis, it was as long as 4 months. But generally speaking, we tell people that you can expect 12 weeks, so 3 months thereabouts. Okay,
so if you're considering depending on where your tax year is and where your R&D claim is, that might also be a consideration if you're looking at an R&D, or in fact you want to use money to grow your business or invest.
Yeah, I mean, it doesn't happen fast. So if it's something that you feel as though you can put off till the month of your tax year end, it's not.
Okay, and then who makes the decisions on loans and interest rates?
So the members, effectively. So the member trustees make those decisions. As I alluded to earlier in the presentation, there is a professional trustee involved, and their role effectively is to tell you what you can and can't do. But if it's a loan that's for a genuine business reason, back to the company, and the interest rates are what we would consider to be reasonable, so less than 10% or 1% above Bank of England, then yeah, that's absolutely fine. But the members are the ones who get to choose, because effectively the members are the ones who've got control over the pension.
Okay. And then maybe people can work this out for themselves. SIPS or SAS?
Yeah, I think if there's more than one of you and you want to do something collaboratively, it has to be SAS. Even if there is only one of you, then a SAS could potentially be more advantageous than a SIP. Certainly, if you wanted to look at the loan back facility, which isn't available through a SIP.
And this isn't in there, but I come across companies that've got a lot of lot of cash in the business where the directors don't want to take it out because of the tax implications. I'd see that as another reason why taking it, for putting a SAS in place and taking it out via pension payments to get tax relief as well. But also, it gives access to the money. It's not, you don't lose access, do you?
No, quite right. Yes, obviously, if you've got a business that's got a lot of cash in it and you're considering sale, or even if it's a situation where somebody's died, then HMRC doesn't look upon those types of businesses as with much generosity of spirit. They consider cash just to be income that's not being taken. However, by making contributions to a SAS or pension scheme, then obviously you're getting money out of that business into personal hands without any negative tax connotations for the individual at that particular point. So it's not taxable. It's not taxable.
And again, one that's not in here, and I will cover the other three in a minute, but just while I think of it, if I want to do, I'm thinking about packing up, retiring, I want to do a management buyout, or I decide to sell the business, what happens to the SAS?
Well, it depends. So if there are members of the SAS who are still going to be within the business or within an MBO situation like that, it might very well be the case. The SAS can just continue. You can continue to be a member as a retiree and draw benefits directly from the SAS if that's what you wanted to do. Alternatively, you can take your section of the SAS away and put it into a personal pension or a SAPE, or buy an annuity with it, or whatever, and manage your own retirement situation from there. So they're perfectly portable, and they're very, very flexible at retirement. If everybody's retiring, then and the business has been sold elsewhere, interestingly, you can still keep the SAS, even without the sponsoring employer being your employer anymore. If it was a family, for instance, and it was yourself and your wife and perhaps 2 children, you just keep it as a family pension scheme. It's very tax efficient. Again, going back to the IHT situation.
So it doesn't necessarily go with the business.
Doesn't go with the business, no.
No, okay. And then the last three. How much can I put in?
I think we covered that off, didn't we? So 40,000 a year, but you can carry forward unused relief from the previous 3 years.
And that's taxed in the company and not the individual, isn't it?
That's right. It's an employer pension contribution to a SAS, generally speaking, which attracts corporation tax relief.
And does the SAS have to submit a tax return?
It does.
Right. And who would do that?
So the professional trustees would typically organise that as part of what their duties. Okay. I think I'll just pick up on that for a moment. People think, Vic, that because the words professional trustee, it sounds expensive. But generally speaking, the costs of running a SAS, even if you've got property and got a loan in there might be 5 or 6 members, would max out at £4,000 or £5,000 per year. For a single member scheme where they're not doing very much with it, it's less than £2,000 a year.
Okay.
Now, if the assets within that pension scheme are 500,000 plus, and you think back to a box standard pension with Standard Life or Aviva or Scottish Widows, you might typically be paying 1% per annum for that because it's 1% as opposed to a flat rate. Then you'd be paying £5,000 a year for a Scottish Widows pension invested in a default fund that you never look at. SAS isn't expensive. It's expensive if you've only got £80,000, but anything above £200,000, and it starts to make actual fiscal sense, which when you think about the advantages that you have over personal pensions within the SAS, it makes it actually really good value.
Okay. Thanks for that. So we've come now to the end of the webinar and the presentation. If there's any questions, there's a chat pod there that you can type your questions in. Maybe you haven't got any now, and perhaps maybe you'll think of them later. And at the end of this, which is our last slide, we've got contact details for both myself and Wayne. Please feel free to call both of us, or either of us, or with any of your questions. We'll be quite happy to take them on. And normally this is a subject that sort of sits with people, and they sort of toy with it and go off and talk to other people within their business or family about it, and maybe come back to it in a week or two's time. So please feel free that the door's open and you can contact us at any time if you've got any further queries. And as I said earlier, this presentation will be emailed in its entirety to you by this afternoon. So unless we've got any questions, which I can't see, I'm assuming now that everybody's content. And with that, I'll say goodbye, and I'll also pass over to Wayne for his goodbyes, and hope to see you again. Thank you very much.
Yeah, thank you. Goodbye, everybody.